Welcome to Investor Copilot. I am Viraj and today we will discuss self-directed trading. So let's get started. Let's look at categories of brokerage accounts. So your online brokerage will allow you to hold and create many categories of accounts. Let's look at them. First of all, we should know about non-margin accounts. These are your standard registered accounts in Canada. That is the TFSA, tax-free savings account, your RRSP, which is registered retirement saving plan, and RESP, which is registered education savings plan. The definition of non-margin accounts is that you cannot borrow funds from your brokerage or any other external source to trade in these accounts. There can be no borrowed funds in these accounts is the rule of thumb for non-margin accounts. Now let's look at margin accounts. We have many types of margin accounts that are supported like individual, corporate, investment club, partnership or sole proprietorship, and trust accounts. What this implies for margin accounts is that the entity or individual that holds the account and runs the account is an important factor. So the control of the account remains with that entity, and this is an important factor for margin accounts. But you're allowed to borrow funds from your brokerage or an external source to trade in a margin account, and that's the rule of thumb. Now, let's look at type of security in a trading account. So there are many types of financial products or securities you can hold in a trading account, right from stocks. It could be Canadian stocks or US stocks if you trade in US dollars, exchange traded funds, ETFs, mutual funds, options, gold and silver bullion, or fractions of gold and silver, or any other metal which is precious as well, you can hold in your account. A bond, which is a fixed income instrument, or a GIC, another FI instrument, and you can have cash in Canadian dollars or any other forex in your account as well. The rules vary from one brokerage to other, but this is a general list of acceptable securities that you can hold in your trading account. Now, let's talk about bid and ask price for a stock or ETF. Bid price is the maximum amount that a trader who is a buyer is willing to pay for a security at that moment in time during a trading session. Ask price is the minimum amount that a trader or who's a seller is willing to accept for a security at that moment in time during a trading session. Now, the mean or the gap between the bid price and ask price over a period of time, it could be a trading session or a given set of time, which could range from a few minutes to a few hours in the trading session, is known as the bid ask spread. This is a vital metric for intraday trading and to predict how the stocks will move. By prediction, I do not mean we are timing the price of the stock, but by prediction, I mean that uh, bid-ask spread definitely indicates the volume of trade on a stock. The wider the bid-ask spread, the lower is the generally the trade volume and lower is the demand for that stock. And the shorter or smaller is the bid-ask spread, the stock is indicated to be in a high volume trade or is in high demand. So please keep that in mind. A bid price and ask price in conjunction with the order type, which we will look at later, and availability of cash in the trading account that you have determine the way an order will be executed or settled. We will elaborate more on this concept later. Okay, now let's look at order types. So when you place an order on the market, what are the types of the orders you can place? There are four broad types and they are not mutually exclusive. These can be used in conjunction with each other. First is the basic type of order, that is a market order. Then you have limit orders. The third is a stop order. And the fourth are timed orders. So let's look at what these are. Well, market order. A market order is an order to buy or sell a security at the market's current best available price. A market order typically ensures an execution, but it does not guarantee a specified price. Market orders are optimal when the primary goal is to execute the trade immediately and you know that the price is right for you. A market order is generally appropriate when you think that a stock is priced right and when you are sure that you want to fill on a trade and you want immediate execution. So a simplest type of order here, we will look at how this is executed as well later on. Let's look at the next one, limit order. A limit order is an order to buy or sell a security with a restriction on the maximum price to be paid with a buy limit or minimum price to be received with a sell limit. If an order is filled, it will only be at the specified limit price or better price. However, there is no assurance of execution for these types of orders if the prices are not reached during a trading session. A limit order now may be appropriate when you think you can buy at a price lower than or sell at a price higher than the current quote that is going on in the market. So here you are placing a strict control on the price of the stock and you're not settling for whatever the market price is. You want your price, you want the best price that you think you can get through the market as it moves, and that's how limit orders work. Let's look at the next one, stop order. Well, a stop order is an order to buy or sell a stock at the market price once the stock has traded at or through a specified price, which is called the stop price. If the stock order reaches the stop price, the order becomes a market order and is filled at the next available market price. So a stop order to sell is basically a stop loss order, and the stop order to buy is an alternate version of stop loss order. We will see what this means. Let's look at an example here. So stop orders example, let's look at the first one. A stock is bought at $90. Stock rises to $100 on the next trading day. Now stop order to sell is placed at $99, which is always generally lower than the market price. Stock drops below 99 before end of trading and stock ends up getting sold at $98.9. Now, what you ensured with a stop order here as a trader is that you ensured you got at least a good gain of $8.90 on this stock. So you did not lose the gains that you got in one day. And as a trader, you thought that your gains are enough for you to square off, and you did that with a stop order. Similarly, the reverse is true. A stock is sold at 100 by you and stock drops to $90 on the next trading day. A stop order to buy is placed at $91. Stock rises above the $91 mark before end of trading and your stock is purchased at $91.1. Here you sold the stock at a higher price and bought it at a lower price. Here you made money from the fall of that stock. So this is a version of bear trading and you did that here and you made a profit here as well. So this is an example of how you can buy with a stop order and still make money. Now let's look at timed orders. Time of an order is important and it can be used in conjunction. To be honest, it has to be used in conjunction with either a market order or a limit order or a stop order. A day only timed order is good for a full day of trading. A good till cancelled order, which is a GTC order, is generally good up to 180 days or until you cancel that order. And a day plus extended hours order, which is an aftermarket execution of order, is good for aftermarket hours as well. Timed orders are little complex and we will look at more examples of timed orders later on when we look at order types and order placement. So stay tuned, lots more to come on this channel and live trading demos will be there. So good to be with you. Thank you.